Wealth and Wisdom is brought to you by the Johannesburg Stock Exchange.
Hello, I'm James Boardman. Last week, on Wealth and Wisdom, we looked at government debt and how the bond market originated in Venice and a tiny bit about how they trade today. Now, central to how and why they trade today and the prices that change in the bond market is inflation, which you as an investor, you need to understand if you want to profit from the bond market. So inflation, what is it? In economics, inflation is the general rise in the price of goods and services over a period of time. Inflation is why things get more expensive over time. It is also one of the most important things to understand when you're thinking about investing over the longer term. Now, depending on how an economy's money system is structured, inflation shows up in different ways. In ancient times, most countries used the gold or silver standards, or a combination of both. In these cases, there were two main drivers of inflation. One was debasement. Gold coins through history have often been alloys, that is, a mixture of gold and other metals. So by taking gold coins and you change the percentage of gold in them, the value of each coin is reduced. That's called debasement, because the noble metal of gold is being diluted with base metals of copper or zinc. Now, the other issue that caused inflation in the ancient world and under these gold and silver standards was new discoveries of gold and silver. So Spain was actually quite affected by this because they got a lot of gold and silver from South America. Now, the interesting thing is that economists around the world are incredibly divided about inflation. Some think inflation is a good thing, and some think any inflation is wrong and represents a surreptitious tax on people. So the interesting thing is, my parents bought their first house years and years ago. I think it was sort of in the early 70s. I mean, it was something like 50,000 Rand. It might even have been a bit less than that. Now, you can't buy a second-hand car for that amount these days. You know, a large amount of that increase in the price is due to inflation. So from sort of the similar house today, it probably costs something more than R1 million. So I mean, that is just unbelievable. From 50,000 to more than R1 million, it's a 20-fold increase in property prices. And that's in one couple's lifetime. I mean, it's a huge, huge increase. The same is true of a lot of shares over time. A lot of their return is due to the change in the value of money. Now, there are several different measures we often hear talked about in the media about inflation. One of these is called CPI. Now, that's the consumer price inflation. You know, this is a measure of the change in prices of a basket, and that basket represents a typical consumer's annual purchases. So some of it you spend on fuel, some on food, some on rent or rent equivalent, and other amounts of the basket you spend on healthcare. This basket and its level are calculated each year by Statistics South Africa. Now, another number often looked at by economists, which you often see in the financial media, is PPI. That's a producer price inflation. So this is the change in prices seen by a manager at a factory who buys raw materials. Now, the PPI, it tends to increase first, followed by the CPI. Now, remember our previous episode was about bonds. So one of the major concerns of investors is that an increase in inflation will reduce the real value of their investment. So bond markets really don't like inflation. Governments, on the other hand, do like a bit of inflation, because inflation means the real value of the loans they owe has decreased. It also means that in effect, all borrowers are let off from a portion of their debts in real terms. So let's look at an island nation where there are only two people, the worker and the employer. Furthermore, the worker only eats oranges. If he earns 10 units of currency and can buy 5 oranges, is he better off when he earns 20 units of currency and can buy 5 oranges? In this case, the price of oranges has doubled, but the worker's salary has too. Thus, he's exactly the same as before. However, due to some sort of psychological bias, the worker feels he's better off. He's getting double the amount of money. He's getting 20 instead of 10. He feels prosperous, but he's pretty sad when he realizes that he is in fact exactly where he was before. So, big problem is inflation is very much misunderstood by a lot of people. I mean, one of the things I think is that trade unions in our country often misunderstand inflation. You know, they say we need to have a reserve bank policy, should try to create some inflation, devalue the currency, and that would then make our exports more effective. They'd make it more cheap for foreigners to buy our investments. the rand gets weaker and our goods become more competitive in other countries. So it's quite interesting. There's also Paul Krugman, famous liberal economist, recently won the Nobel Prize for Economics. Isn't actually the Nobel Prize, it's the Rijksbank Economic Prize, which is not actually funded from Alfred Nobel's legacy. He argued in the New York Times that they need a similar policy. But what these guys don't realize is that unless wages increase more than the inflation, workers will become poorer in real terms. So if the wages increase by more than the inflation, our cost advantage is gone. The other major side effect of inflation is it rewards those who have assets. It really rewards the already rich and punishes those who don't have assets, e.g. the poor. You see, because if we look at this growing inequality around the world, if you're a poor working stiff, like most of us watching this show, then we need to go and negotiate with our bosses for a better salary in the light of inflation. The problem is that's slow. We've got to go and negotiate. It's very tricky. If you are already holding a lot of shares, if you're already holding property, that automatically will go up in price and protect you from inflation. So it happens without you worrying about it. Whereas as a worker, you've got to get out there, you've got to picket and strike to just try and keep up with the rapid rate of inflation. So that's why inflation tends to benefit the already rich vastly over those who just earn a salary, like you or me. After the break, we're going to be looking at inflation and how companies can pass on those increases or whether they can't.
JSE Safex style options, a great choice.